The United States, like many nations, grapples with a colossal debt burden. In 2023, it soared beyond $31 trillion, a figure exceeding its annual economic output. How does a nation manage such a leviathan? Throughout history, governments have resorted to various strategies, often shrouded in secrecy, to manage their debts. One such strategy, inflation, has a direct and often overlooked impact on your personal finances. This essay delves into the intricate relationship between U.S. debt and inflation, revealing how this powerful economic force can be harnessed for personal financial gain. We will explore historical precedents, dissect potential future scenarios, and equip you with practical strategies to safeguard and grow your wealth in an era of escalating inflation. Buckle up, as we embark on a journey to understand and conquer the debt monster. To grasp the present, we must first understand the past. The U.S. debt saga is a tale of evolving monetary systems and strategic maneuvering. In the early 20th century, the U.S. operated on a gold standard, tethering its currency to the value of gold. This system imposed fiscal discipline, limiting the government's ability to print money at will. However, the gold standard's rigidity proved unsustainable during economic crises. The Great Depression, a period of economic devastation, forced a paradigm shift. The U.S. abandoned the gold standard, granting the government greater control over its currency. This transition to a fiat currency system, where money derives value from government decree rather than a physical commodity, opened the door to inflation as a debt management tool. By increasing the money supply, governments can effectively dilute the value of existing debt. Imagine a pie representing the total value of the economy. Increasing the money supply is akin to adding more slices to the pie. While the size of the pie remains the same, each slice represents a smaller portion. This is the essence of inflation, a decrease in purchasing power caused by an increase in the money supply. Inflation is often perceived as a negative force, eroding the value of savings and increasing the cost of living. While this is true, it is only part of the story. Inflation can be a double-edged sword, benefiting borrowers at the expense of lenders. For governments burdened by massive debts, inflation offers a subtle yet potent solution. As inflation erodes the value of currency, the real value of existing debt decreases. Consider a scenario where the U.S. government owes $1 trillion. If inflation averages 3% annually over a decade, the real value of that debt shrinks considerably. This is because the dollars used to repay the debt are worth less than when the debt was incurred. However, this stealthy default through inflation is not without consequences. It can undermine confidence in the currency, erode purchasing power, and disproportionately impact low-income earners who lack the means to hedge against inflation. The government must carefully calibrate its inflation strategy to avoid triggering runaway inflation, which can destabilize the entire economy. While inflation poses challenges, it also presents opportunities for savvy individuals. Just as governments can leverage inflation to manage debt, you can employ similar strategies to protect and grow your wealth. The key lies in understanding how inflation impacts different asset classes and adjusting your investment portfolio accordingly. Inflation erodes the value of cash holdings, making it a poor long-term investment. Conversely, assets like real estate, commodities, and equities tend to fare better during inflationary periods. Real estate, often considered a tangible asset, tends to appreciate in value alongside inflation. Commodities such as oil and gold are essential resources whose prices rise as the value of currency declines. Equities representing ownership in companies can benefit from inflation as businesses raise prices to offset rising costs. However, not all companies are created equal. Seek out companies with strong pricing power, efficient operations, and a track record of navigating inflationary environments. To fortify your finances against inflation's erosive effects, a multi-pronged approach is essential. Firstly, diversify your investment portfolio, reducing your reliance on cash and increasing your exposure to inflation-resistant assets. Consider real estate, commodities, and equities as potential hedges against inflation. Secondly, prioritize debt reduction. As inflation erodes the value of currency, existing debts become easier to repay. Focus on paying down high-interest debts first, as these pose the greatest threat to your financial well-being. Thirdly, consider investing in inflation-protected securities, such as Treasury Inflation Protected Securities or TIPS. TIPS are bonds whose principal value adjusts with inflation, providing a guaranteed return that outpaces inflation. Finally, stay informed about economic trends and government policies. By understanding the forces shaping the financial landscape, you can make informed decisions that safeguard your wealth from inflation's erosive effects. Inflation, once a hidden tool of governments, is now a force we must all reckon with. Understanding its impact on the U.S. debt and your personal finances is crucial for navigating an increasingly complex economic landscape. By embracing a proactive approach, diversifying your investments, and staying abreast of economic trends, you can turn this challenge into an opportunity for financial growth. The future of finance lies in adaptability and informed decision-making. As governments grapple with mounting debts and employ inflation as a debt management tool, individuals must adapt their financial strategies to preserve and enhance their wealth. By embracing the principles outlined in this essay, you can navigate the complexities of inflation, safeguard your financial future, and emerge stronger in an era of economic uncertainty.